If you are 62 or older and you own a home, here is important information to know about tax reporting and financial planning for senior homeowners. Starting May 1st, 2026, certain financial institutions will follow updated reporting requirements for specific transactions involving senior homeowners. Many seniors may not be fully aware of how these changes could affect their records, so it is helpful to understand the details in advance and prepare thoughtfully. This includes information on reverse mortgages, home equity loans, and some property transactions that millions of seniors consider as part of their retirement strategy every year. What used to be handled mainly between you, your lender, and your attorney will now include additional reporting to the Internal Revenue Service in certain cases. Understanding these updates can help you prepare properly and avoid unnecessary complications with your taxes, Medicare premiums, or Social Security benefits. The positive side is that there are completely legal and straightforward ways to organize your information and manage your situation effectively. Seniors who prepare in advance often find the process smoother and can focus on enjoying their retirement with greater peace of mind and financial stability. In this guide, we will explain exactly what is changing, who it may affect, what the IRS will receive reports about, and 3 practical steps you should consider taking right now to protect your home, your income, and your retirement security. We will also discuss broader considerations that can support long-term planning and help you make informed choices about your home equity. For decades, senior homeowners in the United States have benefited from the equity they built in their homes over many years of ownership and careful maintenance. You may have paid into your home for your entire adult life, watched its value grow through market changes and personal improvements, and seen it become your largest financial asset and a source of security. For many seniors, that home represents not only a place to live, but also a nest egg, a retirement cushion, and a legacy they hope to pass on or use wisely. Tapping into that equity through responsible options like reverse mortgages, home equity lines of credit, or a well-planned property sale has often been a private financial matter between the homeowner, the lender, and legal professionals. Starting May 2026, certain transactions connected to senior homeowners will now require lenders and closing agents to report details directly to the Internal Revenue Service. This change aims to improve overall tax compliance, close reporting gaps, and ensure greater accuracy across different age and income groups in the tax system. The new reporting rules focus mainly on 3 categories of financial activity. First, disbursements from reverse mortgages, including lump sum payouts and monthly payment streams that seniors receive when using a home equity conversion mortgage, known as a HECM, which is the most common type insured by the federal government. These products allow seniors to access home equity without monthly repayments while continuing to live in their home as long as they meet the loan terms. Second, home equity loans and home equity lines of credit, often called HELOCs, where the borrower is over the age of 62, and the loan meets certain threshold amounts set for reporting. These can provide flexible funding for home repairs, medical expenses, or other retirement needs. Third, property sales where the seller is a senior homeowner and the transaction may generate what the IRS considers a reportable gain or income event. Many seniors sell to downsize, move closer to family, or transition to different living arrangements that better suit their current lifestyle and health needs. It is important to note that not every home sale or every reverse mortgage will automatically create a tax issue for you. These updates simply mean the transactions will be reported in a more structured way than before, promoting transparency. This distinction is significant because it allows both you and the IRS to have clearer records and reduces the chance of misunderstandings. Understanding why this is happening can make the process less confusing and help you see the bigger picture. Over recent years, the IRS has reviewed tax compliance across various demographic groups and identified areas where reporting gaps existed for some seniors receiving substantial funds from home equity. In some situations, this was due to genuine lack of awareness about documentation requirements or the complexity of rules after decades of home ownership. In others, it related to unintentional oversights in record keeping over long periods. The federal government identified potential revenue shortfalls and responded by implementing mandatory reporting so that lenders and relevant parties file disclosures with the IRS when qualifying transactions occur with senior borrowers. This approach is part of broader efforts to modernize tax administration and make sure systems are fair and efficient for everyone. In simple terms, details about your transaction that previously remained primarily between you and your lender will now be shared with the federal government as required by the updated rules. The IRS will receive the report ahead of your tax filing in many cases. If there is a difference between the reported information and what appears on your return, even if it results from a simple misunderstanding or missing paperwork, it could lead to a request for clarification or further review. This shift means it is wise to maintain complete and accurate records so you can respond confidently if needed. The burden of proof in any review often falls on the taxpayer to show that everything has been handled properly, which is why preparation and good organization are valuable tools for seniors navigating retirement finances. Taking time to understand these elements now can save effort and reduce worry later. Let us talk about the practical side of these changes so you know what to expect in everyday terms. Suppose you have had a reverse mortgage for several years and you have been receiving regular monthly payments that supplement your retirement income. Previously, the lender provided the funds and you managed your spending, budgeting, and any related planning without extensive additional federal cross-checking in every instance. Under the updated system, the lender will report the total disbursements for the tax year to the IRS. When you or your tax preparer file your taxes, the numbers will be cross-referenced by automated systems. If the information does not align, it may generate a notice asking for more details or supporting documents. In some situations, this could lead to an audit or adjustments, along with potential penalties, back taxes, or interest if underpayment is confirmed over multiple years. Being proactive helps prevent these outcomes. Here is a key point that brings clarity and reassurance. Reverse mortgage proceeds themselves are generally not classified as taxable income. The money you receive is treated as a loan advance against your home equity rather than earnings or wages. This is an important advantage for seniors seeking flexibility in retirement. However, the IRS reviews the full financial picture when large sums are involved. They may examine whether Social Security benefits have been calculated correctly according to your overall situation, whether Medicare Part B or Part D premiums need adjustment based on your income level through established formulas, whether any deductions related to your home or loan were claimed properly and supported by records, and whether interest handling follows current guidelines. Any of these areas can require attention if records are incomplete, and the new reporting provides more data points for accurate review and cross-checking. Home sales are another area where many seniors benefit from careful and early planning. Under existing tax law, if you sell your primary residence and have lived there for at least 2 of the last 5 years, you can exclude up to $250,000 of profit from taxable income as an individual, or up to $500,000 if married and filing jointly. This is a valuable benefit that supports seniors who choose to downsize, relocate to a warmer climate, move nearer to grandchildren, or transition to a community with more accessible features. Still, the exclusion applies specifically to your primary home and depends on accurate calculation of your gain. Your cost basis starts with the original purchase price and can increase substantially with documented improvements such as kitchen renovations, bathroom updates, new roofing, added decks, flooring replacements, energy-efficient windows, or other qualifying projects that add value or extend the life of the home. When a closing agent files the required report, the IRS will know the full sale price and other transaction details. If the apparent gain exceeds the allowable exclusion and you lack sufficient documentation for your adjusted cost basis and improvements, you could face a higher tax obligation than anticipated. Many financial professionals emphasize that the main risk is not intentional errors, but simply missing or incomplete records after decades of home ownership, moves, or life changes. For example, if you purchased your home in the 1980s for $85,000 and sell it today for $680,000, the gain before exclusions could be substantial. Every documented improvement over 40 years can help reduce the taxable portion in a legitimate way. But you need receipts, contractor invoices, bank statements showing payments, or other proof. Even partial records can make a meaningful difference when added together, so starting to collect and organize them now is a practical and worthwhile move that pays off in the long run. Social Security benefits are another topic many seniors want to understand clearly in this context because they form a core part of retirement income for most people. Most people know that earned income before full retirement age can temporarily reduce benefits through the earnings test. What surprises some is how combined income from various sources affects taxation of benefits. Combined income includes your adjusted gross income, non-taxable interest, and half of your Social Security benefits. For individuals, taxation of up to 50% of benefits can begin at $25,000 of combined income, and up to 85% at $34,000. For married couples filing jointly, the thresholds are $32,000 and $44,000 respectively. If reported home equity transactions increase your perceived income in a given year, it could influence how much of your Social Security is taxable, even though the proceeds themselves are usually not directly counted as income. Proper accounting, documentation, and timing of decisions can help keep everything aligned and predictable. Medicare premiums also deserve careful attention because they are calculated using modified adjusted gross income from 2 years earlier. If you experience a higher income year due to a home sale, a significant equity withdrawal, or another reportable event, your Part B and Part D premiums could rise under the income-related monthly adjustment amount rules. These adjustments are designed to reflect ability to pay but can feel impactful on fixed incomes. The updated reporting helps federal agencies have consistent data, making it important to plan ahead so there are no unexpected monthly increases that affect your budget for groceries, healthcare, or daily living. For seniors living on tight incomes, even small premium changes can feel significant over time, which is why organizing records and consulting experts early supports better financial wellness. Now let us focus on the positive actions you can take to manage this responsibly and build confidence. The first recommended step is to meet with a tax professional who specializes in senior and retirement issues. Try to do this soon, rather than waiting until deadlines approach. Look for someone experienced with home equity, Social Security coordination, Medicare rules, and federal reporting requirements, rather than a general preparer only. Bring key documents to the meeting: your original home purchase papers, records of major improvements, recent statements from any reverse mortgage or HELOC, your last 2 years of tax returns, and recent statements from Social Security or Medicare. This information allows the professional to spot potential gaps, suggest solutions, and create a clear plan before any reporting creates questions. A specialist understands the unique complexities seniors face, including the intersection of housing, healthcare, and benefits, and can provide tailored guidance that supports long-term financial comfort and reduces anxiety. The second helpful step is to organize your home improvement documentation thoroughly and systematically. If you have owned your home for 10, 20, 30, or 40 years, you have likely made upgrades that add to your cost basis and improve livability. Older records can be challenging to locate after time passes, but it is worth the effort for peace of mind. Search through old folders, storage boxes, digital emails, online banking history, and photo albums that might show before and after images of projects. Contact previous contractors for copies of invoices if possible, check with your local building permit office for renovation records, and review homeowner insurance files that may show when major systems like roofs, HVAC units, plumbing, or electrical work were updated. Any supporting evidence is better than none and can reduce taxable gain meaningfully when you sell. Taking time now to gather these materials creates a stronger foundation for future decisions and can even be useful if you need to file insurance claims or value your home accurately. The third step involves reviewing your current reverse mortgage or HELOC situation if you have one, or researching thoughtfully if you are considering one in the future. The tax treatment of reverse mortgages is generally favorable because proceeds are loans rather than income, but the details are technical, and the new reporting means closer attention from the IRS to ensure compliance. Request a complete transaction history from your lender that lists all disbursements, fees, and interest charges over the life of the loan. Keep this in an organized folder, along with other important papers for your tax advisor. If you are thinking about taking out a reverse mortgage, consult your tax professional and a HUD-approved counselor beforehand so you can understand the full picture, compare options, and structure it in a way that aligns with your overall retirement plan and minimizes any future complications. This proactive review supports better decision-making and helps you use home equity responsibly as one tool among many for retirement security. It is also wise to think more broadly about how these elements fit into your overall retirement picture and daily life. Many seniors find that combining good record keeping with professional advice allows them to use home equity confidently while protecting other benefits and maintaining lifestyle flexibility. For instance, maintaining accurate files can help if you ever need to support claims about deductions, basis adjustments, or benefit calculations. Regular communication with a trusted advisor can also alert you to other planning opportunities, such as timing decisions around sales or withdrawals, to align with tax years favorably or coordinating with estate planning goals. Seniors who take these steps often report feeling more in control of their finances and less worried about unexpected notices or adjustments. Additionally, consider how your home fits into your long-term health and family plans. Simple modifications for accessibility, energy efficiency, upgrades, or maintenance routines can preserve value and comfort while potentially qualifying as improvements that strengthen your records. Beyond the immediate reporting changes, remember that homeownership in retirement brings both opportunities and responsibilities that deserve ongoing attention. You remain responsible for property taxes, insurance, maintenance, and upkeep, even with a reverse mortgage in place. Planning carefully helps ensure your home continues to serve as a stable foundation for your later years rather than becoming a source of stress. Many seniors successfully use these financial tools to supplement retirement income, cover healthcare costs, support family members, or fund travel and hobbies while staying compliant with all rules. The key is education, consistent organization, and preparation rather than reaction. Developing good habits around financial paperwork, digital backups of important documents, and annual reviews with professionals can make a big difference in how smoothly things go. The updated mandatory reporting requirements for senior homeowners that begin on May 1st, 2026, are a meaningful development in how home equity transactions are tracked and reported. Reverse mortgages, home equity loans, and certain property sales will generate automatic reports in qualifying cases. Yet, with clear understanding of the rules, well-organized documentation, and guidance from a qualified tax professional, you can handle these changes smoothly and with confidence. The objective is never to pay more than you legally owe, but to know exactly what is required, document it properly, and file accurately so your retirement years remain secure and enjoyable. Nothing more and nothing less. You currently have time to meet with professionals, gather your records, review your loans, explore options, and address any questions proactively. Taking action now reduces stress and potential costs compared to addressing issues after they arise. Many seniors discover that this preparation not only helps with tax compliance, but also provides greater overall confidence in their retirement plan and daily decision-making. It allows you to focus on what matters most: spending quality time with family, pursuing hobbies and interests, traveling if desired, volunteering in your community, or simply living comfortably and safely in the home you worked hard to own and maintain over the years. If you found this information useful, consider subscribing to the channel for more practical content and timely updates on senior financial topics, retirement planning, home ownership strategies, and wellness tips for later life. Staying informed is one of the best ways to protect your security and make confident decisions in the years ahead. Thank you for watching, and best wishes for a secure, healthy, and fulfilling retirement.